rush into cutting rates. He was speaking at an Australian Financial Review Business Summit via live stream. Diamond said the Fed should wait past June before cutting rates. He also said the Fed could afford to wait for more data, and if needed, it could always cut quickly and dramatically, going on to say that the Fed's credibility is at stake. Diamond highlighted the US economy is still going strong, almost at a, quote, boom, but he isn't ruling out the possibility of stagflation. He sees the odds of a recession at around 65% and even said the recent run-up in markets looked a bit like a bubble. Okay, who better for reaction and a response to this than Frederique Carrier, Head of Investment Strategy at RBC Wealth Management, joining me live now. Frederique, always good to have you on. Thank you so much for joining me. So Diamond says the Fed should wait past June before cutting rates. He says your credibility is at stake. It got me thinking, is he wrong?
Well, we'll have to see what the data is telling us, but we are expecting the first Fed cut in June. And depending on how inflation comes through, depending on how the economy behaves, it's not necessarily one cut per meeting after that. So there could be a pause if it's warranted, but the first cut, in our view, is going to be in June.
Frederique, he also said the run-up in markets looks a bit like a bubble. Should that be a warning shot on equities? I know you've just upgraded Europe, for example. You seem like the bull case in your own bull case in equities still pretty much intact at this point. Diamond says there could be a bubble forming. Your reaction?
Look, we're getting a lot of questions from our clients, particularly with respect to the US and the technology stocks. There's been a very strong advance in share prices for the last year. The Magnificent Seven, the top tech stocks, have gone up 80%, whereas the S&P, excluding technology, is up only 10%. So we think it is a valid question. But if we look at the tech bubble that we had in the 1990s, we feel things were very different. The top 4 stocks back then were trading on a trailing PE of more than 80 times. The S&P, excluding those, was on 23 times. And of course, a lot of companies didn't have earnings. Management was not so experienced. Today, the Magnificent Seven are trading on trailing PE ratios of less than 40 times. Clearly not cheap, but not these extreme levels. And the S&P, if you strip out technology, is on a lower 21 times earnings. We have to remember that the companies which are leading the markets are companies which have a track record of really growing earnings, management with a lot of experience. So we don't think that it's similar. We think that there is still a possibility of higher highs in the market because the breadth of the market is still very wide. And investor sentiment, while definitely elevated, is not extreme in our view. So we continue to be constructive on equities, and we don't think it's a bubble, something to be watchful for, but not at the moment.
Okay, absolutely fascinating. And you said still a possibility for higher highs in some of these stocks. Well, the run-up has been pretty strong already, and it's also come as we've seen expectations for higher for longer interest rates stateside as well. Frederique, we are counting down for the release of the US CPI number. What are you expecting this time round, and what's the impact that it could have on stocks?
We are in line with consensus. We expect core CPI, that's really where the focus is, to be 0.3% month over month. The Fed would probably want to see better progress, would probably want to see 0.2% core CPI month over month. So this is why we think it will wait until June. But again, by June, we do expect a cut. And markets are well braced for that. Expectations are no longer overly optimistic about rate cuts. So we think that the market will take this in its stride.